The U.S. economy grew at a faster pace than expected in the second quarter. The second revision for GDP clocking in at 3% versus the 2.8% economists had expected. That's according to the Bureau of Economic Analysis. Now, the data potentially a good sign for the Fed that growth is not slowing too quickly here. Now, here with more on his take here, we've got Robert Sockin, who is Citi's senior global economist here. Okay, so latest GDP revisions. Also, thank you for coming in studio here with us today. Great to see you. First, as we think about what these GDP revisions mean for how the Fed is really evaluating the economy as according to their dual mandate here, is there anything that they could take away from this that would move their policy direction one way or the other in September?
Yeah, absolutely. And thanks so much for having me. It's a great question. On the one hand, these data are a bit of old news because it's in the second quarter. We already knew that growth in the first half was fairly strong. It was a modest revision higher. So in terms of that, a bit of old news, although still good news. But on the other hand, one thing that you see in these data, and you've seen that continue into the third quarter, is the consumer still looks to be holding up pretty well. You saw solid consumer spending in the first half, and we've had 2 strong months of retail sales in recent months. And so right now you're getting wobbles in the labor market. That's the biggest concern. But so far, the consumer does not seem to be rolling over. So that would be my major takeaway from the first half data and what we've seen from the consumer in the third quarter so far.
So how are you looking at the potential risks to the economy right now? Because there's still the unknown factor about the Fed. There's still the election. Yes, the consumer's holding up, but we have seen some signs of a more choosy consumer. So how do you see that all playing out when we think about growth through the end of the year and into 2025?
Yeah, absolutely. And this is the key question because the risks, I think, are more skewed to the downside in recent weeks. You've seen our Citi Economic Surprise Index that looks at how data are coming in relative to expectations. That has fallen sharply in the third quarter, and data, broadly speaking, have mostly missed the mark and come in below expectations. Now, that being said, growth was very strong over the last year, so expectations may have been a bit too lofty, and it's not necessarily a recessionary signal on its own, but it does show that things are slowing down. And the question becomes, are we slowing down into a soft landing, or are we slowing down into a recession? I think, as I said, the balance of risks have shifted more to the downside. But to me, the data still feel more like a soft landing. You're still seeing decent consumer confidence that picked up in recent data, decent consumer spending. And if you look at some of the high frequency indicators we saw this morning, jobless claims are still really low. So there's some question about how much is the labor market loosening, but so far you're not really getting those layoffs. And I think that's what you really need to see for this economy to show signs that it's really turning down sharply.
And so what would that translate into the unemployment rate if we're kind of looking at and zeroing in on the employment situation as a barometer for whether or not we've actually struck and are in a recession, which won't be called until well after we've actually seen
it. And that's the exact challenge is how do you know when you're in it, if you're in it? And, that's what got a lot of focus early in August because the employment report, the unemployment rate moved up to 4.3%. It triggered the SOM rule, which historically has been an excellent barometer for recessions in the post-war period. But that being said, this time could be a little bit different in that much of the rise or a fair amount of the rise in the unemployment rate has been due to increasing labor supply rather than weakening labor demand. So for the unemployment rate, it's possible it could move up even further from here for quote unquote good reasons that more people are coming into the labor force. Now, in terms of what that means for the Fed, I think it's very challenging because they know the SOM rule, they know that's a predictor of recessions or an indicator you're in recession. And if the unemployment rate keeps moving up, even if it's for more people coming into the labor force, I think it's going to be very hard for them not to get worried about those recessionary risks. I think they'll start moving very aggressively. So it's a very tricky balancing act right now. You could be getting good moves up in the unemployment rate, but it's hard to tell when you're in that moment.
So let's zero in on the Fed because post-Jackson Hole, I've seen a lot of commentary from Fed officials that it's more important about the pace of rate cuts and not the amount. Markets are pricing in about 100 basis points worth of rate cuts. Do you expect that we'll get that by the end of the year? Or do you think the Fed's going to be more methodical in the approach? And does the Fed have the luxury to be methodical at this point?
Yeah, and it's really challenging. So, and there's a heated debate within our own economics group about how fast they'll move and what's happening to the U.S. economy. As I mentioned, a lot of the rise in unemployment rate has been for quote unquote good reasons or better reasons, people coming into labor force, but it's still concerning how much the unemployment rates moved up. And so from a risk management perspective, that might lead the Fed to be a bit more aggressive in its initial moves, especially if they think there's a high risk that the economy is slowing down sharply. So, our US team is looking for them to start off with 50 basis points and another 50 after that. So they actually have 125 basis points for this year from the Fed. Now, if you look around the world, most central banks have opted for gradualism in this cycle. I mean, if you look at the ECB, they did one cut and then they paused. And you've seen that from other central banks like the Bank of Mexico. So this has been a very gradual, cautious cutting cycle because I think central banks don't want to lose those hard-won gains that they had on inflation from earlier in the cycle. So I think right now it's hard to tell. Markets are pricing in a decent probability of a 50 basis point cut, but the base case is 25. To me, that feels about right, but we'll see how that next employment report comes in. I think, again, if the unemployment rate moves up more from here, it's going to be very hard for them not to move more aggressively.
We'll see that employment report, and then also in a few weeks, that Fed meeting in September. Robert Sockin, Senior Global Economist at Citi, thank you so much for joining us.
Thank you.